Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of the A.O. Smith Corporation, ticker symbol AOS. A.O. Smith is a dividend aristocrat that has steadily increased its dividend payouts for each of the past 29 years. So at the time of recording this video, A.O. Smith is trading for $60.30 per share. Year to date, their stock price has gone down quite dramatically. They're down 30%. Over the past year, their stock price is down 16%. Over 3 years, they're up at a rate of 10% compounded annually. Over 5 years, that's only 2.5% compounded annually. Over 10 years, that's 16.5% compounded annually. And since the global financial crisis, A.O. Smith's stock price has returned about 20.5% compounded annually. So just absolutely crushing the overall market here. In addition to these stock price returns, A.O. Smith also has paid out this increasing dividend. Currently, they have a 1.8% dividend yield. So A.O. Smith is trading closer to their 52-week low than they are to their 52-week high. They're about $8 over their 52-week low right now. A little over 3.5% of their shares outstanding are currently sold short, and they have about a $9.3 billion market cap overall. So for some background about the business, A.O. Smith Corporation manufactures and markets comprehensive lines of residential and commercial gas tankless, and electric water heaters. Supplementary products include water heating equipment, condensing and non-condensing boilers, and water system tanks. The company's two operating segments are by geographic region: North America, which constitutes the majority of total revenues, and the rest of the world. A material portion of sales in North America derive from replacing existing products, and the company utilizes a wholesale distribution channel and multiple selling locations. The rest of the world segment sells primarily to Asian countries and operates sales offices to expand distribution and market its product portfolio. A.O. Smith Corporation was founded in 1874 and is headquartered in Milwaukee, Wisconsin. For our fundamental analysis today, we're going to be performing a modified version of the 8-pillar analysis popularized by Everything Money, taking a look at 8 key financial metrics of A.O. Smith's business to come to a holistic and beginning understanding of the company based on those fundamentals. So let's get right into it. Starting off with pillar number 1, we want their average 5-year PE to be below 22.5. So currently, A.O. Smith is trading at about 18.5 times earnings. Over this 5-year time frame, they've dropped to a low of about 15.5 times earnings, and they've traded as high as 39 times earnings. Overall, however, they've traded at an average of 25.5 times earnings, so this is a little bit above that metric we were looking for. So unfortunately, this is going to be an X here to start off. Next up, for pillar number 2, we want their average 5-year return on capital to be above 9%. So over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. So A.O. Smith, for being a manufacturer of water heaters, earns a surprisingly high and surprisingly steady return on capital. Over this time frame, A.O. Smith has produced returns on capital between this 20 and 30% range. In an average year, they're producing about 25.5% returns on capital, which is close to 3 times the 9% metric we were looking for. So this is a big check here. A.O. Smith is able to produce surprisingly high returns on capital. Next up, pillar number 3, we're looking for 5-year revenue growth. Their revenue has gone up some, not a ton, from about $3 billion in 2017 up to about $3.5 billion in 2021. So this is going to be another check here on pillar number 3. Pillar number 4, we're looking for 5-year net income growth. They've also increased their net incomes from $296 million in 2017 up to $487 million in 2021. So another check here on pillar number 4 as well. Pillar number 5, we're looking for decreasing shares outstanding. So A.O. Smith has reduced their share count from 174 million shares in 2017 down to 161 million shares in 2021. So over this time frame, they bought back about 7.5% of their shares outstanding. This is excellent, and this is going to be a check here. This is really important because when you purchase a stock, what you're really buying is a fractional ownership percentage in that underlying business. And so when a business is buying back shares and decreasing the amount of stock that they have outstanding, They're increasing your ownership percentage in the business, which is ultimately going to increase the percentage of the business's profits that you're going to be entitled to as an owner. You're not going to have to spend extra money to get a higher ownership percentage in a business that you already bought shares in. So we want companies that are buying back shares when their business is reasonably priced, or better yet, undervalued. So A.O. Smith has been buying back shares over this time frame, which has increased existing shareholders' ownership stakes in the business. So we like to see this. This is a check here on pillar number 5, and so far through 5 pillars, we've got 4 checks. Let's keep it going. Next up, pillar number 6, we're looking for 5-year free cash flow growth. Free cash flow is cash from operations minus capital expenditures. It's this column here in green. Free cash flow is the lifeblood of any business and can be used to pay dividends, buy back shares, make acquisitions, pay down debt, or reinvest back into the business. A business's abilities to produce free cash flows, discounted back by some reasonable interest rate, is ultimately what that business is going to be worth. So in 2017, A.O. Smith produced $232 million of free cash flow, and that has grown to $566 million of free cash flow as of 2021. So this is going to be a check here. They've more than doubled free cash flows over this time frame. So looking at their free cash flow profile, while they've increased their cash from operations, they've also been able to decrease what was already a pretty light amount of capital expenditures relative to their cash from operations and free cash flows. So this is an excellent sign to see. Between their high returns on capital and their light CapEx nature, in addition to these buybacks that they've been doing, those are all truly wonderful signs to see in a business's fundamentals. So those all bode extremely well for A.O. Smith. In an average year over this time frame, the company is earning $411 million of free cash flow. We're going to be using that number coming up here in pillars 7 and 8. Pillar number 7, we want their net debt, which is long and short-term liabilities minus cash and short-term cash equivalents, to be below their average 5-year free cash flow multiplied by 5. This is going to help us evaluate how the business utilizes leverage. This one's going to be a check without running any math here. A.O. Smith has negative net debt, which means that's after subtracting all of their liabilities, they're actually left over with $400 million of cash as of the end of last year. If we look at their most recent numbers, while they've spent some of this cash so far this year, they still have about $130 million of cash in their net debt position left over on their balance sheet. So again, this is a check here on pillar number 7. The business is cash rich and is not using any sort of excessive leverage whatsoever. Then finally, the big pillar of them all, pillar number 8, we want their market cap to be below their average 5-year free cash flow multiplied by 20 to give us a reasonable starting point for evaluation of the business. So currently, A.O. Smith has a market cap of $9.3 billion. When we multiply their average 5-year free cash flow of $411 million per year, that's only going to bring us to $8.2 billion. We're off by more than $1 billion, or more than 11% here. So this one's going to be an X on pillar number 8. However, this doesn't mean that you're going to completely toss out the business. This type of analysis is a holistic and beginning understanding of A.O. Smith as a business. It's not financial advice, and it's not a buy or sell recommendation. It's really geared at determining whether you want to learn more about the company and whether the company's interesting to you. No business metrics should be taken in isolation here, and just because they're off on their current market cap relative to their abilities to produce average free cash flows, that doesn't mean that you should discount this business entirely. We saw some very promising signs in the rest of their financials, and so potentially A.O. Smith might deserve a higher multiple here, even though it is a low-growth business. However, that's not something we're going to be able to determine in this analysis. That's something that you're going to have to go out and do independent homework on and come to your own conclusions. Then here we're looking at A.O. Smith's dividend profile. A.O. Smith is a dividend aristocrat. They've had 29 consecutive years of dividend increases. So it's no surprise that over the past 5 years, they've increased their dividend payouts in all 5 years. At the same time, they've been able to increase their cash flows in all 5 years, and they've been able to produce plenty of cash per share to be able to have a wide margin in comparison to what they're paying out as dividends. So both their cash flows per share and their dividends per share are increasing in all 5 years here. This looks like their dividend is in excellent shape. Keep in mind that this is a snapshot of the past, however, and this could potentially change into the future. So while it's a very promising sign, it's not a guarantee. Then here we're using a discounted cash flow model to come to a potentially fair value for A.O. Smith. So this is going to be based on their historical growth numbers. So historically, since about 1990, they've been able to grow their free cash flows at a rate of just under 9% per year. So if we assume that that growth continues for the next 10 years, then we have a terminal value stage over the next 10 years. So 20 years out into the future where that growth rate is cut in half, then you could reasonably expect about a 7% rate of return by buying A.O. Smith today, with a fair value at a 7% rate of return of about $61 per share. Keep in mind that this would be including their dividend payments, so we would not be double counting dividends here. If instead you wanted a 10% rate of return from your investment in A.O. Smith, again, based on these historical numbers and these historical assumptions, you'd want the business to be trading for less than $48 per share. So this discounted cash flow model, or DCF model, is based on these historical assumptions. You have to determine for yourself whether you think that these assumptions for their growth are appropriate or not. Because again, ultimately, this analysis is not financial advice. It's meant as a holistic and beginning understanding of A.O. Smith as a company. Before making any sort of investment, please both do your own homework, come to an independent conclusion, and also consult with a financial professional. So in summary, A.O. Smith Corporation checks the box on 6 out of 8 pillars. They're currently off on our valuation metrics. However, they earn surprisingly high returns on capital, given the fact that they're manufacturing water heaters. The business has seen slow growth in revenues over this time frame, but they've seen pretty modest growth in net incomes, and they've actually doubled their free cash flows at the same time. So whether or not this is coming from a down year, we would need to be looking at a little more data to be able to see, but it does look like their cash flows have been steadily increasing all 5 years. In addition to this, the company has also bought back about 7.5% of their shares outstanding over the last 5 years. At the same time, the business has a net cash position on their balance sheet, and with the high difference between the cash flows that they're bringing in per share and the dividends that they're paying out per share, you could reasonably expect that both their dividends and their share buybacks would be increasing into the future. So it looks like A.O. Smith Corporation is going to continue to be able to return capital to shareholders. Then again, based on that DCF model, it currently looks like the business is about fairly valued if you're satisfied with a 7% return based on those historical assumptions. Again, you need to determine for yourself whether those historical assumptions are appropriate or not. And if you're looking for about a 10% return on the business, you would need this stock price to fall to under $48 per share. Again, using those same assumptions with the same caveat. So with that said, that's it for today's fundamental stock analysis of A.O. Smith Corporation, ticker symbol AOS. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next. Thanks for learning about A.O. Smith with me, and have a great day.